All right, so what I'm going to do is I'm going to close the chat box because I don't want it to be so distracting. I know it just floats on the screen here. And then I'm going to go through my presentation and then I'll open up the chat box again to look at the questions. So I'm hoping that the recording is starting right now because we are going to get underway. All right, hello everyone. This is Kathy Lien with 3Ms of Forex trading. It's been a while since I've had the opportunity to speak to everyone here at FX Street, so I'm delighted to be able to join all of you today. In the end, there's a lot of stuff that's going on in the markets, and I think it's important to be aware of the things that could potentially move the markets. Now, some of you may have heard me talk about the 3Ms of Forex trading before. The 3Ms of Forex trading are basically macro, micro, and monetary policy. Now, each one of these things affect currencies differently, but they all tend to have a pretty big impact on how the markets are moving. Now, before I get too much into it, though, if you look at the very bottom of your screen, you'll notice that there is a disclaimer. And the disclaimer says trading Forex carries a high level of risk and may not be suitable for all investors. So for those of you that are watching this recording on demand, I highly encourage you to pause the screen, read through the disclaimer thoroughly before moving forward. So getting back to the 3Ms, as I said, if you are trading currencies on a fundamental basis, or if you're just trading currencies in general, the best way to start or to approach things is on a fundamental basis is to drill down everything into the 3Ms: macro, micro, and monetary policy. Basically, macro determines the big trends. Sorry. Macro determines the big trends and the big moves in the markets. And micro, and that's basically, determines things like, for example, the overall uptrend in the US dollar or the overall downtrend in the euro. And micro, and that basically sets, kind of the general tone for trading in a currency. Micro, on the other hand, determines affects the day-to-day movements of currencies. And when we talk about micro, we talk about, things like Friday's non-farm payrolls report, Canadian GDP numbers, things like that that can be important, but have more of a short-lived impact on how a currency moves. And then comes monetary policy. It all boils down to monetary policy, where monetary policy, hands down, is the most important thing you should know when it comes to currency movements. If there's nothing that you pay attention to, it really should be monetary policy. And the reason for that is because money shifts from one part of the world to another in seek of the highest yield. And that's very important because, we're in an environment right now where yield is changing, and it's about to change. It's going to change. It's shifting, and all of that has and will continue to play a big role in not only how currencies have been trading right now, but how currencies could be trading in the next 6 months. So I want to start by talking about the 5 themes that have been prevalent in 2015. As we draw the third quarter to a close, these are the themes that have been affecting markets, I guess, since the beginning of the year. So in terms of the 5 themes that have been affecting the markets, one of the most important ones that have now since been resolved, some of these have been resolved, some of these are very much still on the discussion table. But the ones that have been resolved is, for example, the Greek crisis. And this is a pretty big deal, in my opinion, because the resolution to some of these issues, particularly the Greek crisis issue, has and will continue to play a very, very big role in how the euro trades. The euro up until today had been holding pretty strong, in my opinion, hanging tight for the most part. And So basically, hanging tight for the most part. And it's because, some of the major issues or strains that had been crippling the currency in the first part of the year has basically evaporated. We are no longer in an environment where the market is paranoid about whether or not Greece is going to bring down the euro, whether or not they are going to be in a situation where we basically see an environment that is causing an existential crisis for the euro. Now, is this completely over? Probably not, simply because no. The greatest problem with the euro is that it's a fractured region, I guess is the best way to describe it. And the whole notion of the euro is that basically, with the currency, you've got other countries that will have political and economic crises in the days, weeks, months, maybe not days, weeks, months to come. And that could come back and return as an issue for the currency. So another big theme for 2015 that is still very much in place is Chinese stocks and Chinese growth, or a better way to say is the lack of Chinese growth and the decline in Chinese stocks. This has been a huge, huge issue crippling the currency, and it's something that we pay very, very close attention to, because overall, when it comes to how the currency pair, how currencies in general trade, risk appetite plays a very, very big role. And not only for the commodity currencies, but for stocks in general, stock markets, in the US, stock markets in the Eurozone. Overall, you're in a situation where slower Chinese growth, weaker Chinese demand, and the threat of just general vulnerability in China's economy is and will continue to really hamper movements in commodity currencies. I mean, it's a pretty big deal here, and I think it's something that we should not underestimate at all, because overall, when it comes to weaker Chinese growth, if the Chinese economy remains soft and continues to weaken, the rallies that we've seen, for example, today in the Australian, New Zealand dollars will fade and fade quickly. Now, the Chinese growth is also having a significant impact on the region, where it's making investors and consumers very nervous. So unfortunately, while the Chinese government has been quite aggressive in responding to some of these issues, I don't think they're going to be overly aggressive, because their focus really is on internal demand and internal growth. So given that their focus is on internal demand and internal growth, the whole idea here is that they want to boost up the middle class. So that will and obviously this or boost up the lower class to the middle class, and that internal focus will definitely have its consequences or be taken from somewhere. And I think that they realize there will be a bit of slower growth that could be a result of that. Another big theme of 2015 is oil prices and the decline in oil prices. Oil prices have fallen very significantly this year, and it has broad-based ramifications. Not only is the decline in oil prices and commodity prices in general negative for commodity currencies. Not only is it negative for commodity currencies, but it also affects inflationary conditions in many parts of the world because low commodity prices leaves inflation kind of weak. And you saw this morning with Germany, they reported a decline, the Eurozone reported a decline in price pressures, indicating that even though Bundesbank President Wiedmann believes that deflation is less of a concern, the numbers show something very, very different. The numbers show that deflation is still very much a concern. And it's not just for the Eurozone. You also see this concern or this pressure in Japan. Japan earlier, I think this month, last week reported its core CPI report, and it dipped back into negative territory for the first time since April 2013. So what does this mean for the currencies? Well, it means that those central banks will basically lean towards keeping monetary policy easy, and more specifically, it could even trigger a desire to basically increase quantitative easing. And that's something that we're watching very, very closely because one of the key hotspots is Japan. There's a very good possibility that Japan could increase quantitative easing at the end of October. And so, if they do decide to increase quantitative easing at the end of October, that would very much be motivated basically by this reduction in inflationary pressures. Stronger dollar. I'm gonna just take a look at the chat screen because I see a lot of people saying hi. Okay, so all right, good. Stronger US dollar. Also a very, very big story in 2015, where the strength of the greenback has driven a lot of currencies to multi-year lows, and it's a pretty big issue. It's one that we watch very, very closely, and more significantly, I think that when it comes to the stronger dollar, we're maybe at the cusp of the dollar getting even stronger. Now, there's a lot to talk about that because Federal Reserve rate hikes after a long period of steady rates is not always necessarily positive for a currency. In fact, it can actually be negative for a currency. But anyway, more specifically, what I think is important to realize is that the stronger dollar is not something that's going to go away completely, and it also has global ramifications. And then finally, policy divergence. Policy divergence has been a big topic for 2015 and will continue to remain a big topic for the rest of the year into 2016. Monetary policy divergences have led to very big swings and wide moves in currencies, and I think that it will very much be something that the market's focusing on in the days, weeks, months to come. So we live in a diverging world, and this is a little graphic that I stole off of, or I've taken from, that was created by BlackRock. And you can't see the bottom of the screen, but let me zoom out. I think you can see it. Or maybe let me make this a little bit full screen. So over here, what you'll see is that the dark green colors are the countries that have been implementing QE. The light green colors are the central bank countries that have been cutting interest rates. The gray is the no change, and the purple is a rate hike. And sorry about that. Let me just need to clear my throat. All right, so You can see the colors are diverging, and we're going to be in an environment where some of the grays, like the US and the UK, are going to move into the purple area, and some of the, light greens will get to the dark greens. And so this divergence creates plenty of opportunity in trading currencies. And that's the way you have to think when you think about the 3Ms. Now, in terms of the next 6 months, we talked about how some of the things that we talked about are very much going to remain at the forefront of conversation. Now, others will not, but in general, we think that the main focus in the next 6 months will continue to be a divergence in monetary policy, and more specifically, if you take a look at, this is more nicely polished chart that shows you, how different things are moving. But if you take a look at this chart, you see a lot more in the dark green area, fewer a lot more in the light green area, fewer in the dark green area. You see a lot of these buckets start to move. So the main themes for the next 6 months is we've got to look beyond the Fed. The Fed's probably going to raise interest rates, but what happens next? Europe. Is it getting back on track? Well, I mean, we had some crappy data this morning, but overall, I think that we could be moving into an environment where we basically do have the weakness of the euro providing, stronger support to the European economy. Not only the weakness of the euro, but also possibly lower commodity prices, lending support to the Eurozone economy. Contagion from China? Yes and no, not to the developed economies, but certainly to the Asia Pacific economy. So it really depends upon what part of the world you're interested in and you live in. Major opportunities in Japan and monetary policy divergence. So starting off with the outlook for the Fed. Now, when it comes to the outlook for the Fed, we know that the U.S. economy is ready for a rate hike. And it's just a matter of, because it's not just a question of how well the U.S. economy is doing right now. It's a question of whether or not the emergency conditions that existed to warrant the zero interest rate policy remains in place. And I think all of you will agree with me that the answer is no. The emergency conditions that brought on the zero interest rate policy do not no longer remain in place. And for this reason, we believe that we could very much be in an environment where the Federal Reserve needs to raise interest rates and needs to raise interest rates very, very soon. Labor market's improving. We're getting non-farm payrolls released on Friday. Regardless of whether it's strong or weak, I mean, overall, I think the data is going to show you that the economy the labor market is improving. And from that perspective, I think, overall, what you will see is that the data will support the notion of the Federal Reserve raising interest rates either next month or the end of the year. But bottom line, they're going to be raising interest rates this year. And then inflation. I mean, oil prices, even though they have been low, seem to be bottoming out a little bit. And the decline in gas prices is positive for consumer spending and home building. So the U.S. economy, in a nutshell, is ready for its first interest rate hike in 9 years. The case for a rate rise can be made in this chart here from BlackRock. It's a pretty fabulous chart where you see that wage growth is increasing at a fairly aggressive pace. And last month we had a very nice improvement in wage growth. But inflation expectations are falling. And so what the sorry, not they're falling, but they've fallen and they're stabilizing and moving higher. And one of the greatest fears of the Federal Reserve is that inflation expectations is going to rise. You can see it's pretty volatile, rise very quickly because wage growth is rising so quickly. So what they really want to do is get ahead of this. That's what the Fed is trying to do, in my opinion. They really want to get completely ahead of this, and they want to basically preempt a sharp spike in inflation. So looking at the first rate hike, this is an older slide. I mean, it's just say October versus December. It's just a debate between October versus December. Either way, I think it's happening. It's going to be happening this year, and it's just a matter of how quickly they want to do it. And I think October is very much on the table, especially if non-farm payrolls is good. We're gonna have a rush of expectations pricing in October tightening. And what should we expect from the dollar? Well, what's interesting is that the dollar. While it tends to rise, and this is the dollar index, in the first 24 hours after the Federal Reserve raises interest rates, take a look at this chart. 3 months later, the dollar index, you can see that in a couple weeks later, you see the dollar index ends up falling after rate hikes. It actually did a little study that I haven't posted here, but the study shows that 3 months after the Federal Reserve raises interest rates for the first time, and we looked at 30 years worth of tightening cycles, and in those 3 months, the dollar index ended up lower by 3.7%. So the dollar index ended up lower, even though as the Federal Reserve raised interest rates during that 3-month period. So rate hikes are not necessarily positive for the US dollar, though will be when the Fed first raises interest rates. So looking beyond the first rate hike, what's the opportunity? Well, we can anticipate a little bit of a medium-term dollar rally going into the first rate hike. We don't know whether or not it's going to happen. Whether or not it's going to happen in October or December. But, going into the rate hike will be a dollar rally, sell into the day that the Federal Reserve raises interest rates, and then don't buy dollars for a little bit until after the rate hike. Stocks, you'll probably see stocks fall, and we'll see a flatter yield curve. There'll be underperformance of U.S. stocks and lower commodity prices. These are all consequences of a Federal Reserve rate hike. And this just shows you how the yield curve is shifting, and when the Fed raises interest rates, we expect the yield curve to flattening. In general, rising U.S. rates hurts U.S. dividend-paying companies, low volatility companies, and low volatility companies such as utilities, real estate, and consumer staples, and it helps bank stocks. So these are just some of the things that you could trade, whether CFDs or FX. We expect weakness in U.S. equities, so you can trade any of these CFD instruments, and lower commodity prices and a flatter yield curve, as well as the dollar itself is a little bit trickier. Another theme, is Europe getting back on track? That's an important question to ask for the next 6 months, because we believe that, putting Greece back in perspective, it really did not have too much of an impact on the Eurozone economy. What we learned from the Greek crisis is that the ECB is going to do everything in their power to prevent any country from leaving the Eurozone. So they're going to be providing the ultimate backstop. The Eurozone economy is going to get support from the lower euro, ECB quantitative easing, and lower oil prices. And we're finally seeing credit creation beginning to happen. And in the last quarter, more than 55% of Eurozone companies beat expectations. So the drivers of Eurozone growth and a recovery in the euro, we believe, will be the following. Basically, we believe that you're going to be in a situation where Quantitative easing is, the ECB has already told us that quantitative easing is front loaded. They already told us and they indicated that, even that they don't feel that it's necessary to do more quantitative easing at this time. So we believe the ECB is done in September 2016. By that time, there'll be stronger external demand, improved financial conditions, and we'll also see an end of austerity in the peripheral countries. But the bottom line is that the euro and lower oil prices will be very stimulative for Eurozone economy because oil has dropped more than 25%. It was dropped 25% more than what people expected. So European opportunities, fear of Brexit to pass, they are already passing. Euro still headed to 105, but it's going to be a bumpy road because even though we think that US dollar is going to rally a bit, I think it's going to be a bumpy road with some nice opportunities to the upside. European equities, probably a little bit of potential gains in recovery. So you can trade the European 50 or 10-year boon. Chinese contagion. Will there be Chinese contagion? We had massive reversals in Chinese equities. This has since stabilized a little bit, so people are less worried. But overall, though, I think that that Chinese stocks, the bubble has burst. It ran up very quickly over between August to about June. And even though it's fallen about 35–40%, it's still, this is Shanghai Composite Index, is still up a lot from the beginning of from the past year and even from the beginning of the year. Now, the decline in Chinese stocks are caused by legitimate problems. Margin accounts for 85% of all stock trades. And Chinese regulators basically blessed low IPO prices to get investors interested. And those artificially low IPO offering prices have increased volatility. And now they're paying the price because those shares are plummeting. And even though and it's a legitimate issue because more than 3 trillion asset value has been wiped out as a result of China's problems, which is twice the size of India's markets. But we know that the government has responded and will continue to respond aggressively. They've suspended IPOs, suspended trading stocks, even said they were going to arrest some short sellers and manipulators. They established funds to buy stocks. So the bottom line is, they stand ready to step in the markets, and they've proven to us that they very much are willing to step in the markets to stem the slide in the currencies. So, yes, we believe that Chinese meltdown will damage global and domestic confidence and hurt the economy, but we believe that the systemic risk is going to be limited to China. And the global economy won't see as much pain because most of the Chinese A shares are held by domestic investors. And the longer-term damage to the global economy or markets is unlikely. And also because China has proven that they will continue aggressive monetary policy response to any sort of major downturn in the stock market. And that's why we don't think that tonight's Chinese PMI numbers are really going to be all that terrible. So the question is it time to buy Chinese stocks? No. The Shanghai Stock Index is still up 70%. The PE of A shares is still around 19, which is double from last summer. And bubbles don't really burst. They deflate. Slow and gradual process. More investors unwind their positions. And markets typically going to shoot on the way down. So the bottom line is that Chinese stocks is not cheap. Finally, opportunities in Japan. Drivers in Japanese growth is going to be a weak yen, quantitative easing, lower commodity prices, recovery from a consumption tax, and global growth. And the notion here is that there could be, because of low commodity prices, there could actually be more quantitative easing from Japan. And if we do get more quantitative easing, that is going to be fairly important because that's going to lead to stronger Japanese growth. But the problem here is that the opportunity is not necessarily going to be in the yen because we know that the yen doesn't necessarily move at all. It just moves in the market's appetite for US dollars and definitely not on anything else. So the opportunity is going to be in Japanese stocks. And the Nikkei in particular, I think it could receive quite a bit of a boost from from basically, additional quantitative easing. And the drivers of Japanese growth will be weak yen, QE, lower commodity prices, all the things that we just talked about. And the opportunity is really strong for Japanese stocks because equities benefit from reallocation by Japanese pension funds. That was a big story last year, in the beginning of this year, where the largest funds pledged to up their allocation to 25%, but now they're only at 5%, so they're well below target. So we want to overweight Japanese equities, and you could do that through a lot of companies. Forex brokers offer the ability to trade CFDs like Japan 225, so you can trade it through the 225. And then finally, monetary policy divergence. All of this plays into our idea that there's going to be quite a bit of monetary policy divergence in 2016, late 2015, 2016. And so we're going to be watching that quite carefully. And a lot of these circles are going to start moving in different directions. But how do you translate all these into trades? Well, it's important to incorporate technical analysis because, we have all these big ideas, all these big themes, and we need to incorporate technical analysis in order to fully understand how things are going to be, what are the good places to enter and exit our trades. And some basic guidelines to do so is, be aware of news, be aware of key levels, and be aware of time of day because that can help you pinpoint your entry and exits. So hopefully you enjoyed this presentation, got some useful information. Now I'd like to open up the floor to any questions that you may have. All right, so if there are no additional questions, I'll give you another couple minutes to type in your questions. All right, no additional questions. Thank you so much for joining me and have a great day.